Welcome to our webinar, The Employee Retention Credit, a valuable alternative to emergency loans. Disclaimer: any advice contained in this communication, including attachments and enclosures, is not intended as a thorough, in-depth analysis of specific issues as the news continues to develop. This has been prepared for information purposes and general audience only. You should not act upon the information contained in this presentation-based webinar without obtaining specific professional advice. If you have questions after the webinar, please don't hesitate to contact us regarding your specific situation. No representation or warranty, expressed or implied, is made as to the accuracy or completeness of the information contained in this presentation-based webinar. And KBKG, their members, employees, and agents accept no liability and disclaim all responsibility for the consequences of you or anyone else acting or refraining from acting in reliance on the information contained in this presentation-based webinar or for any decisions based on it. Now, a little bit about our company. KBKG was established in 1999. We have offices across the U.S., including Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. Kevin is a principal of KBKG and is the practice leader for our research and development tax credit services. He has over 15 years of consulting experience providing R&D tax credit services to companies of various sizes, ranging from Fortune 500 companies to small startups. Prior to joining KBKG, he worked with a top national firm focusing on the research and development tax credit. Kevin has been involved with research credit consulting for companies in numerous industries, including defense contracting, pharmaceutical, biomedical device, computer software, semiconductor, food and beverage, agriculture, and consumer electronics. In this capacity, he has successfully maximized, defended, and sustained both federal and state research credits. He is also a frequent speaker and instructor of external and internal continuing education courses. Kevin will also be joined by colleagues and subject matter experts, Principal Martin Bellick-Berger, Director Perrin Kanajan, and Senior Jim Estrella, who will be assisting with the live Q&A session that will begin after the conclusion of the presentation. Please post your questions to the question box. Now, I will turn it over to Kevin.
Great. Thank you, Diana, and thanks everyone for taking some time with us this morning or afternoon, depending on which coast you're on. Here's a brief agenda for what we're going to cover during the webinar. So we're going to start with an overview of what the credit is, and then take a look at how an employer can qualify for this incentive. We're going to take a look at the different types of expenses, primarily wages, that qualify for this credit, and then take a look at a couple of calculation examples using the different criteria. And then, as time permits, at the end, we're going to wrap up with a live Q&A session where we can address some of the questions you might have. As the polling questions come up, if there are questions that are coming through the chat box, I'll present those to Perrin and Martin and Jim to see if they can address those real time. But otherwise, we're going to have some time at the end as well for a live Q&A. So the employee retention credit was included as part of Section 2301 of the CARES Act. It basically allows for qualified employers to take 50% of the first $10,000 in qualified wages in 2020 as a credit. So you're looking at about $5,000 max per qualifying employee. The credit is applicable to payroll incurred beginning March 13th and extends through the end of the year. So it's no longer applicable beginning January 1st, 2021. You would include the credit on your quarterly payroll tax returns that are filed on the Form 941. So really, the objective behind this incentive is it's a source of capital for qualified employers. If you're a qualified employer, you can use this credit to reduce the amount of employment tax deposits that you would have to make every quarter. It's a source of capital. If there's an instance where the credit exceeds your liability for a particular quarter, this would become a refundable credit for you. So what is the qualification criteria for an eligible employer? There are a few hurdles here that need to be met in order to be designated an eligible employer. Number one, you can't be a governmental employer, so that would be a disqualifier. Number two, the employer could not have received a PPP loan, so that is also a disqualifier. Although there is legislation out there that's potentially modifying this credit, and this would be one of the items that would be removed. So an eligible employer that received a PPP loan could qualify for this. However, currently in the way it's written, if you received a PPP loan, this would not, the employer would not be eligible in this instance. The employer must have carried on a trade or business in 2020, and the employer must have either suspended operations during any calendar quarter in 2020 due to government mandate, or experienced a significant decline in gross receipts during the quarter. It's either or, it's not both. Unfortunately, self-employed individuals are not eligible for this incentive. However, tax-exempt organizations are eligible. If an employer is part of a control group or an affiliated group, all members must be considered, and these tests must be applied to all members of the group. So it's important to note that it's either full or partial suspension, right? Partial suspension doesn't necessarily require you to shut down completely. The employer can qualify if the business is impaired due to government orders, limiting commerce, travel, or group gatherings. So let's say you were in the business of hosting conferences. You could still host a conference remotely, but the restrictions on gatherings of a certain size may reduce the amount of staff that you need in order to host the conference. And so in this instance, you could still be deemed partially suspended. If the taxpayer is an essential business, it's unlikely that the employer would qualify, even if their business was affected by the government shutdown. So if you operated a grocery store and decided to discontinue operations for whatever reason, because you were deemed an essential business, you would not qualify for this. Taxpayers that shut down a physical location but are still able to work from home, meaning employees are able to work from home, would not meet the suspension test. Partial closures. So this is for people like, for instance, in the restaurant industry that can offer delivery or curbside pickup can qualify under the partial suspension rules. In situations where taxpayers operate in multiple jurisdictions as part of an aggregated group or control group, and some are suspended by government mandate while others aren't, all members of the group are treated as a single taxpayer, and all members are treated as partially suspended in that instance. Once the suspension order is lifted by the government, the suspension period concludes. And this can really happen at any time. So if let's say you're in a particular quarter, and midway through the quarter the suspension order is lifted, you could potentially qualify for that entire quarter. You can qualify for that entire quarter, but we could only capture the wages associated up to that suspension period. Everything after that would no longer qualify. So the second test for qualification, and this is applied at the employer level, is a significant decline in gross receipts. A significant decline in gross receipts is a 50% reduction in gross receipts for a quarter as compared to the same quarter in 2019. The measurement period begins the first day of the first quarter in which the 50% reduction happens, So, for instance, in the first quarter of 2020, you would look at it from January 1st, 2020, all the way through March 31st. That would be the measurement period, and you would compare it to the same quarter in 2019. Even though you would only be able to capture the wages beginning March 13th, you would still compare that entire quarter. The eligibility ends on the first day of the quarter following the quarter in which gross receipts are greater than 80% of the receipts from the same quarter in 2019. So if you dip below 50% in the first quarter, and then in the second quarter come back and you're at 80% of what you were in 2019, the eligibility would end beginning on the first day of the third quarter, and that may sound a little bit confusing, but and so we've inserted an example on the next slide that'll hopefully walk you through that and make it a little clearer. The definition of gross receipts comes from IRC section 448 and includes net sales, so no returns, as well as income from investments, services, interest, rents, royalties, and dividends. Basically, it's everything in the income section of a Form 1120. Taxpayers that do not have, taxpayers don't have to prove that a decline in gross receipts was due to COVID-19. So there is no test, where you have to show that our business declined and it was due to the pandemic. For aggregated groups, the decline in gross receipts must be determined at the group level. So again, control group and affiliated groups, you have to combine everything and apply the test to the group level. So if you have one of the entities, that declines substantially while another one increases substantially, you would combine, compare, and in that instance, it may or may not be a qualifying employer. So here's the example that we were talking about in terms of the gross receipts. So in Q2, you see in 2019 the taxpayer had $250,000 in gross receipts. In the second quarter of 2020, that dropped to $120,000, which represented a 52% drop. In Q3, however, the gross receipt came back a bit, and now 210 is more than 80% of what it was in 2019. So for this employer, they would no longer qualify beginning the first day of the fourth quarter. So we would be able to capture the wages associated with Q2 and Q3. Basically, we can go all the way back and claim everything from the end of March all the way through September 30th. At that point, they would no longer be a qualifying employer. And as I mentioned earlier, there are controlled group and affiliation rules that are applicable to this. Control groups are under Section 52, and affiliated groups are under Section 414, are treated as a single taxpayer. So when you're trying to determine eligibility, you have to look at the entire group as a single taxpayer. This would be applicable when trying to figure out if the trade or business was suspended, and we talked a little bit about that earlier. It would be applicable in order to determine the decline in gross receipts, and again, you would have to combine them all and look at it as a single taxpayer. And for the entire group, it would be applicable when looking at whether or not there are more than 100 full-time employees, and all employees would have to be aggregated into a single group in that instance, and we're going to talk a little bit about that later. And if one of the entities receives PPP funds, as it's written now, that would eliminate the entire group from qualification. So once you've determined whether or not the employer qualifies for this, you would need to look at the number of full-time employees associated with the employer. The number of full-time employees has to do with whether or not the individual employees qualify for the credit. So this is, in determining, once the employer qualifies, look at the individual employees and see which ones do or don't qualify, and making that determination is, the method that you use in order to determine that is based on the number of full-time employees that you had. Calculating qualified wages depends on the number of full-time employees for the taxpayer in 2019. The definition of a full-time employee is either an employee that averages at least 30 hours of service per week or 130 hours of service per month. It's either or. If an employee meets either one of these tests, they're considered a full-time employee. If the taxpayer operated its business for all of 2019, you would have to take the total number of employees that either average 30 hours of service per week or 130 hours of service per month and total that up for all 12 months. Then you would divide that by 12. So you have to look at the number of employees in each month that either worked 30 hours per week or 130 hours per month. Add that up for all 12 months, divided by 12, and that tells you what the average number of full-time employees were in 2019. If a company began operations in 2019, instead of dividing by 12, you would have to divide by the number of full months they were in existence. So let's say a taxpayer began operations in January, let's say January 15th, you would divide by 11 instead of by 12 because it's considering full months of existence, and you began in January, so the first full month would be February in that example. If you began operations in 2020, you would still qualify for this. You would use the same method as I just walked you through for partial 2019 existence, except you would use 2020 as a number in that instance. The credit is based on qualified wages. The way qualified wages are determined, as I showed you previously, is based on the number of full-time employees in 2019. Compensation is defined under Section 3231 and includes the employer's qualified health plan expenses associated with each qualifying employee. The qualification criteria at the employer level is unchanged. So regardless of the number of employees you have, your operations would have either had to be suspended due to government mandate, or you will have had to experience a significant decline in gross receipts. After you've met that qualification criteria at the employer level, you would look at the employees, and for an employer with less than 100 full-time employees in 2019, the qualified wages are amounts paid to any employee during a calendar year quarter. If the taxpayer has more than 100 full-time employees during 2019, the qualified wages are the amounts paid to employees not providing a service. So in other words, you're paying them not to work. If an employee is compensated their full salary, but they are not working the entire amount, the creditable amount would only be the incremental difference. So for instance, if you have an employee that was paid 100% of their salary, but only working 40% of the time, the creditable amount would be the incremental difference, so that's 60%. So if they were paid $10,000, 60% of 10,000 would be 6,000. That would be the qualifying wage, and you would be eligible for credit. That would be 50% of the 6,000, which would be $30,000. I'm sorry, $3,000. So here's an example of a credit calculation for an employer with less than 100 employees. Since there are less than 100 employees, it doesn't matter whether the employees were providing services or not, just as long as the employer is qualified, meaning they were affected by a government-mandated shutdown or the receipts were significantly affected. Included here for the employees are their wages and their qualified health insurance to the extent it's applicable. So employee one was paid, the total qualifying wages for employee one would be $12,500, and that's $10,000 for qualified wages and $2,500 for the qualified health care plan. And then for Q2, 3, and 4, it would be $7,500 each quarter. Employee 2 was paid $6,000 each quarter, and employee 3 was paid $1,000 each quarter. So here's the calculation based on the information in the previous slide. Employee 1 was paid $12,500 in Q1, but the credit is based on the first $10,000 in total wages. Since the entire $10,000 qualified, the credit for employee 1 in Q1 is 50% of that, which is $5,000, and you can see that in the table below. The Q1 credit for employee 1 is $5,000. Employee 2 was paid $6,000 in Q1, and applying the 50% limitation gets us a $3,000 credit in Q1 for employee 2, and you see that there. And then employee 3 was paid $1,000, and we got $500. So total Q1 credits were $8,500. Now, as we move into Q2, you'll notice employee 1 no longer qualifies, and that's because we exhausted the entire $10,000 in Q1. And again, just as a reminder, we can only qualify the first $10,000 in wages for each employee. The employer still qualifies though, and in Q2, because we only qualified $6,000 in wages for employee 2 during Q1, there's $4,000 left to qualify, and that gets us another $2,000 in credit during Q2. For employee 3, we get $500 per quarter for a total of $2,000, and then you'll see there the total credits for the employer were about $12,000 for 2020. So here's an example with an employer with over 100 employees. We're only showing 3 employees for demonstration purposes here. The other difference between this example and the previous one is that the employees were paid for non-work hours, and that can be seen in the furloughed wages column. And again, because there are over 100 employees at this employer, the only way to qualify the individual employees, even though the employer qualifies, the only portion of the qualifying expenses associated with the employees are the non-work hours. Okay, so the way the furloughed wages column, that 2,500, basically is telling us that 25% of their total wages paid. So for employee 1, you see $10,000 were paid in Q1. 25% of that was for non-work hours, so 2,500, and then the total qualified is 3,125. And the way we're coming up with this is we're saying, okay, the entire amount of the 2,500 for furloughed wages is qualified, and then the prorated portion of the qualified healthcare expenses, so 25% of the other 2,500 is also qualified. So 25% of 2,500 is $625. When you add that to the $2,500 in furloughed wages, that gets us a total qualifying wages of $3,125 for employee 1 in Q1. And then we repeat that exercise for each quarter for each employee. And that brings us to the credit calculation associated with that information. So here's the resulting credit. As a reminder, the creditable amount is 50% on the first $10,000 in qualifying wages. Therefore, for employee 1 in the first quarter, we can capture 50% of the first $3,125, since that was all that was qualified, and that got us $1,562.5 in Q1. The total qualifying costs for employee 1 during all of 2020 is $8,750. So, basically the sum of all qualifying wages was $8,750. We never got to the $10,000 max, and the total credit for employee 1 is $4,375. And then it's basically a rinse and repeat exercise. The total credit for employee 1 is $4,375, and that's based on total wages of $25,000 and $10,000 in total qualified health care costs. So how do you take the credit? The tax credit is taken on the payroll tax return, which is the federal form 941. It's generally filed quarterly. The returns are due the month after the quarter. So the first quarter 941 is normally filed in April. The second quarter would be filed in July, third quarter in October, and then the fourth quarter would be filed in January 2021. Qualified wages are those wages that are incurred beginning March 13th through March 31st. So that represents the end of the first quarter. Obviously the first quarter filing is already done since we're through April. The instructions state that the payroll incurred from March 13th through March 31st would need to be included in the second quarter filing. The credit provides employers access to federal employment taxes. So these are amounts that you would otherwise need to pay and are a source of capital for the employers. If the amount of the credit is higher than the employer's share of tax liability for a quarter, then the employer can request an advance of the credit by filing a Form 7200. This is the aspect of this that makes it refundable. Basically, the credit is refundable if you generate more credit in a quarter than you have tax liability associated with your employment taxes in that quarter. And here's an example of applying this on the 941. So if you have an employer that has $5,000 in credit for a particular quarter on $10,000 in qualifying wages, and their liability is $8,000, they can keep $5,000 and only need to deposit $3,000. So the total liability is $8,000. They have a $5,000 credit. They only need to deposit $3,000 in employment taxes for that particular quarter. If the credit was $5,000 and the liability was only $4,000 instead of $8,000, meaning they have more credit than they have liability, then they wouldn't have to deposit anything. And then the additional $1,000 would be refundable as an overpayment, and then they can file a Form 7200 to request that amount back. There's nothing that states how long it's going to take them to give you that money back. We just know that they are at this point. So here is the draft of the revised Form 941. You can see the employee retention credit will be entered in line 11C. The IRS has indicated that they're going to require documentation in order to substantiate claims, but they've not yet indicated what that documentation would have to be. I would think it would be things like, confirmation that no PPP funds were received, credit calculation details, work papers showing what is and is not qualified in terms of wages, substantiation around why certain employees would be qualified, substantiation around the qualification of the employer, with respect to salaried employees, how their qualified wages were calculated. And this would be particularly true if they were working from home but not working full time and still compensated. So I think it would be things like that. That's probably where most of the questions would arise and where you would need the most amount of substantiation. And here's the rest of the form. Line 13D is where you would enter the refundable portion of the employee retention credit. So to the extent you have more credit than you do liability, this is where you would enter that. If you receive an advance as a result of the Form 7200, so this would probably be quarter 3 or 4, you would enter it on line 13F. Line 21 is where you would enter the qualifying wages for the credit. Line 22 is the qualifying health plan expenses. During the second quarter filing, line 24 is where you would enter the qualified wages from March 13th through March 31st. And again, that's the end of the first quarter. So during the second quarter filing, this is where you would enter the qualifying expenses from March 13th through the 31st. If an employer qualifies for this credit but doesn't include it on one of their payroll tax returns, they can file an amended payroll tax return. That would be Form 941X. So this doesn't have to be done on timely filed returns. What you wouldn't do is take second quarter information and include it in the third quarter filing. Instead, you would file an amended payroll tax return. If you use a PEO, you still qualify for this credit. The PEL would be the party that would file for this on your behalf. You would still be responsible, however, for providing them the information they need for an accurate filing. So the credit the taxpayer receives from this would not be included as gross income as well. That's another thing that's important to note. This isn't income for taxpayers. However, the expenses, the qualified expenses that result in the credit would also not be included as part of the federal income tax return. So when does the credit end? Well, as I mentioned earlier, it's only applicable to wages paid through the end of the year. So expenses incurred beginning January 1st, 2021 would no longer qualify. If the employer is qualified based on government order, then they would stop being qualified when the order is lifted. And again, looking at a particular quarter, if the order is lifted mid-quarter, we can capture everything up to that point, and everything subsequent to that would no longer qualify. And that's under just that government order test. Now, if you know, the employer would still qualify for the entirety of the quarter, we would only be able to capture the expenses up to the government order being lifted. If they still meet the gross receipts test, obviously we can capture everything for the entire quarter. Here's an example of that. Basically, you know, if let's say the government order was put in place on March 13th through the end of April, so April 30th, we can claim the wages incurred from March 13th through March 31st related to the first quarter. We can also claim the wages incurred from April 1st through April 30th for the second quarter. However, beginning May 1st, we would no longer qualify, and then also we would capture March 13th through March 31st, and April 1st through April 30th on the second quarter filing on the 941 that's usually due in July. And there are some interactions with some of the other PPP or some of the other CARES Act programs out there. You know, first and foremost, if you receive PPP funds, you wouldn't qualify for this credit. You can take both the employee retention credit and the medical leave credit, but not on the same wages. So since the employee retention credit is applicable to the first $10,000 in qualified wages, you can apply the medical leave credit to wages incurred after the first $10,000 an employee receives. Additionally, you can't take the employee retention credit and the wage opportunity tax credit on the same employee. So the WOTC credit is normally applied at an employee level. So if you're taking a credit on a particular employee, they're not likely to qualify for the employee retention credit at that point. And so this last slide is just meant as a reference guide and summarizes many of the programs out there. The Fed has provided an enormous amount of liquidity to taxpayers, and there are a lot of resources out there. So hopefully there's a program out there that will help you. You know, obviously this ERC program, I think the first wave of people looking at this were probably after the PPP stuff, but the second wave, I think, you know, especially those that didn't receive the PPP loans are going to be looking for additional assistance out there, and I think the employee retention credit is going to be particularly useful to them. Again, there's legislation out there floating around that would potentially expand this program, expand it from the first $10,000 in wages to more, expand it from 50% of, you know, to a higher percent. And you know, you should be on the lookout for that. If something passes around that, we'll certainly put out some information on our blog or send out an article kind of highlighting the changes around that. But with that, we've reached the Q&A portion. You know, with plenty of time here, so we've reached the Q&A portion of the webinar. I'm going to turn it over to Diana and Jim to walk through some of those questions and see how many of those we can address in the time we have remaining. Thank you for your time. Jim, do you want to take it from here?
Yeah, thanks, Kevin. I could not said or explained any of that better myself. So I think we're going to start with some of the easier questions here that came in through the presentation. So the first one is a household employer eligible for the ERC? And the answer to that is no. Next question has to do with the type of eligible employers. For example, a Schedule C taxpayer. So the question is, if you are a Schedule C taxpayer, can you take the ERC? Well, you're probably not paying wages to yourself as a taxpayer, and if you did, you could not take the ERC. However, if you paid wages to employees that were not yourself, those wages would qualify for the ERC. Kind of a related question that also came in are about shareholders of C and S corporations. Those wages also qualify for the ERC. Looks like we've got some more questions about the interaction with the PPP loans and some of the other CARES Act loans, and I think I'm going to turn that one over to Perrin. So Perrin, can you dive in a little bit more of, are there any employers that get a PPP loan? Can they take the ERC at all?
Thanks, Jim. First of all, let me address actually the other loan that was brought up in several of the questions, the EIDL loan. The EIDL loan and the ERC are not mutually exclusive. So you can get an EIDL loan or a grant and still qualify for the ERC. With regard to the PPP loan, however, it does disqualify you. If you have received the PPP loan and have not returned it by May the 18th, then you're not eligible for the ERC. Also, this applies to companies in a control group or affiliated service group. So, for example, if you are part of a control group or an affiliated service group, and any of the companies in that group have taken a PPP loan, then nobody in that group can qualify for an ERC loan. So the PPP is mutually exclusive of the ERC, but that does not apply to the EIDL loan. You can have both EIDL loan and the ERC. I think hopefully that answers a lot of the questions that came out around the ERC and these loan programs.
Thank you, Perrin. So the next question we've got, I think I'm going to turn over to Martin to answer. And the question is, if you have a taxpayer with multiple trader businesses, one of which is considered essential, the other one is not essential. So you've got a situation where the essential business carries on while the non-essential business does not. How is that treated in terms of the ERC? Is that employer qualified to take the ERC or not?
Well, the ERC is subject to two tests, right? The first one is the reduction of 50% of gross receipts. So if that's the case, I think it's irrelevant whether you're under a government shutdown or not, you would qualify for it. But if your gross receipts are in excess of 50% of the gross receipts that you had in the same quarter in the prior year, the question becomes, is it a partial shutdown, and is that sufficient to get the credit? And the IRS has not actually issued final guidance on this, but my gut reaction is that yes, you would qualify for some of the ERC credit because you are under a partial shutdown, and they have not ever said that you have to bifurcate your business. As a matter of fact, they've said you had to aggregate your businesses under the common control rules.
Thank you, Martin. Looks like we've got another question for you, and that question is, if you lay off employees but continue to pay their health insurance, would those health insurance costs be eligible to take the ERC?
Yeah, that's a great question, because this is something that really hasn't been brought out as much as it should have been. But yes, they do qualify. If you continue to make the health insurance payments for your furloughed or laid off employees, those payments do qualify up to the maximum of $10,000, just the same as other qualified wages. And, for larger employers that have, several hundred employees, this can be a huge benefit. We're just looking at one of the cases where we're talking about a benefit, maybe in the $500,000 to $1 million range. So yes, they do qualify. The people are not working, so 100% of the healthcare benefits do actually qualify up, of course, to the limit of $10,000 of benefits and a $5,000 credit.
Thank you, Martin. So next question has to do with the taxability of the employee retention credit. And the answer to that is it is not taxable income to the taxpayer that receives it. And at the same time, the deduction is disallowed for the amount of payroll that's been credited by the government. So basically, the purpose here is to restore the taxpayer to the extent of the credit as if those wages were never even paid. So you're not out the money, but you're also not being taxed. And since you're basically at net zero, you're not going to double dip with another deduction on your tax return. So looks like we've got another question here, and I'm going to turn this over to Martin. So question is this a credit that you can only claim against payroll taxes, or could you also take it on your tax return?
No, this is a credit that is only allowable against payroll taxes, but I think sometimes we just make sure that we understand what payroll taxes are. They also include your, federal income tax withholding, so that tends to be a bigger number sometimes than your FICA wages or Medicare wages, which is what the credit is how you compute the wages for your credit purposes. So you do get that. And to the extent that your credit is in excess of that amount, you can get a refund of that amount with Form 7200. So it's a very broad application of the credit and should work pretty well.
Thank you, Martin. So I think we've got another question for you, and it has to do with the definition of suspended operations, either partial or complete. I think more on the partial side. So we're seeing a lot of states and communities doing a gradual reopening of certain businesses. So, for example, you've got a restaurant that initially you started with, you could only do pickup and takeout orders, and that was clearly stated with the IRS that did constitute a partial suspension of operations, but now we're starting to see governments lax it and allow some dining in-house, but definitely not to the extent prior to all this. So where is that line between partial suspension and not?
Well, another good question that I don't necessarily have a really good answer to because, those kind of regulations have not been issued by the IRS. But my gut reaction is, first of all, are you still under the 50% of gross receipts? If you are, then the governmental test is irrelevant. And it is the test that will allow you to probably get a higher credit amount either way. However, if you're not under the 50% test, I would assume that, it's probably kind of a reasonableness test. If you are allowed to have 25% of your customers come into your restaurant or a third or something along those lines, I would assume, and I would go under the assumption that that does qualify as a partial closure under government authority, and I would go ahead and claim the credit and then just do full disclosure of what you're doing. If you're largely capable of doing what you were doing before, then I would guess that you probably don't qualify for the credit. But like I said, the IRS has not issued any real guidance in this particular area.
Thank you, Martin. Another question for you, and that has to do with a taxpayer that was under a suspension of operations by a government order that ended June 1st, or will end June 1st, and the taxpayer continues to stay closed on their own will. So would the taxpayer then continue to be considered suspended?
I think the taxpayer would under the gross receipts test, not under the governmental authority test. But it's clearly if they remain closed and their gross receipts were less than 50% of what they had in this example, in quarter 3 of their prior year, I would assume that they would qualify for the ERC.
I think that's a good point you brought up, Martin, is under the sales test, you're definitely looking at a bigger period of time that wages paid could be eligible for the ERC versus the suspended operations test.
Correct. Yeah, I think you can also just I think you could claim the suspended operations test for, let's say, the first quarter, where you maybe, for a lot of people, the first quarter you probably didn't have a 50% drop in gross receipts because the pandemic hit largely in March, and most of the governmental authority orders were issued in March sometime. So I think, probably for most taxpayers, the first quarter you probably did not have a 50% decrease in sales, and it was probably more likely to happen in the second quarter. So you could use the governmental suspension test in the first quarter, and you could use the other test in the other quarter.
Perfect. Thank you, Martin. So let's see, another question for you is the stay-at-home order that's ordered by the government, is that the only qualifier here that outside of the sales test, or if you have another stay-at-home order issued by a physician, does that allow you to be qualified for the ERC?
No, that the laws pretty state that it has strict that it has to be issued by a governmental authority. So I would assume that would include anything from a municipal, city, state, any municipal government authority. But I don't think any other. It's very very clear that it is a governmental authority order. So.
Perfect. Thank you, Martin. So another question here is there a published list of essential businesses for purposes of the credit? And I believe the answer to that is really dependent on the local government that is actually out there saying what businesses need to shut down and which ones don't. So I believe in the state of California that guidance really came at the state level. Martin, do you have anything else to really add in on that point?
No, I think you're right, Jim. I think it's the response to the pandemic has not been like universal. Every state has had their own rules. Every city has had their own rules, and I think so you have to do it on a city by city, state by state basis to see what was considered an essential business and what was not.
Perfect. So the next question has to do with actually receiving the ERC, and the question is, if you filed your 941, let's say for quarter two, and then subsequently determine that you were eligible to take the ERC, what are your options? So I believe one option is to file an amended 941. Your second option is to file Form 7200, which would then allow you to receive a refund in either case. Martin, do you have anything else that you want to maybe clarify there?
No, I think that's accurate. I think I would probably go ahead and file an amended 941 and claim the credit.
And I think a related question here is there's a lot of employers out there that are required to make more periodic deposits, either not long after that when they do paychecks or maybe even twice a month or so on. So I believe in that case you could still claim credit on the 941 and then just receive a refund after the filing.
Well, I think there's a mechanism there that allows you to get the credit faster, as I see it, which is, once you know what your credit is, and, certainly, we can help you compute that, but once you know what your credit is, you can actually reduce the amount that you're paying over to the government with your, weekly, biweekly, whatever it is, payroll tax deposit, and essentially you would just retain that money now versus and then you would claim the credit on your 941. You wouldn't get a refund then because you would have retained the money and not paid it over to the government. So there is a quicker way to the money by following that path.
Perfect. Thank you, Martin. Another question here for you. It has to do with a business that just started in 2020, so they were not operating at all in 2019. Do they qualify for the credit?
Yes, I think we kind of covered that a little bit, in terms of for a business that was not actually that's a good question because clearly if you weren't in business for all of 2019, you would qualify, but if you were just a brand new business, but I'm not 100% sure on that answer. Let me get back to you on that.
Hey, Martin, it's Kevin. I believe you do qualify. Same method used in 2019, in terms of full months that you would apply to 2020.
Makes sense.
To determine. Yeah, but you do qualify. The answer is yes.
Okay. Thank you, Kevin.
All right, next question here is if you use a payroll service provider can you still take the credit? And the answer to that is yes. They would just need to, you need to provide them with the credit amount, and they should be able to include that in the 941 that they file on the taxpayer's behalf. Let's see here, just going through our questions. Okay, another follow-up question on the brand new business, and the question to that is, how do you pass the decline in revenue test if you were not open in 2019 at all to compare 2020 revenue versus 2019? Martin, any thoughts?
I don't think you would qualify for the drop in the more than 50%. You would probably have to go under the shutdown, shutdown under governmental authority. I don't recall there being any verbiage in the law that allowed you to, because there's no comparison that you can make to the prior period. So I think you would have to go under the governmental authority shutting you, partial or total shutdown of your business.
Right. So I think we've got our last question here that we're going to have time to take, and it's also going to be for Martin. And are there any related party rules that come into play as far as claiming the ERC?
Yes, absolutely. You have to look at, regardless of whether the business entity is a corporation or a partnership or a trust or whatever it may be, you have to look at the aggregation rules to determine the employer, and these are the same aggregation rules that we use for many other tests in the Internal Revenue Code. It's the brother in the corporate side, and really on the partnership side as well. It's the brother, sister, or parent subsidiary rules, as well as the affiliated corporation rules. So, yes, you do.
Perfect. Thank you, Martin.
All right.
Kevin, do you want to wrap up?
Yeah. Thanks, guys. Thanks, and thanks again, everyone, for taking the time with us today.